If you look at dollar interest markets, you will see we have a positive yield curve where 3-month interest rates are forecast to rise. Each dot on this graph shows where 3-month LIBOR, as indicated on the financial futures market, is headed. The market is saying that short-term interest rates will more than double from today's level of around 1.3% to well over 2.6% in the next 10 years. You could lock in your interest rate exposure by using an interest rate swap. So imagine you have a loan on which you pay a floating rate of interest. The bank or swap house agrees to cover your interest expense, whether you're paying 1% or 1,000%. In return, you're going to pay them a fixed rate of interest. You're effectively swapping cash flows, so we also call this fixed rate a swap rate. The swap rate is calculated as the average, taking into account time value of money, of where we think floating rates will go. It will immediately be higher than where the floating rates are at the start. This is what we call a negative carry, where you're paying more on the fixed rate than you're receiving on the floating side. Given that rates are forecast to rise, there should be a time when the fixed and floating rates are similar. Then there should be a time when floating rates are higher than the fixed rate you're paying. But what if you think that rates will go up, but not as quickly as the market is suggesting? Then you're saying that the implied forward rates are too high, and therefore the swap rate is also too high if it's the average of these forward rates. So why pay fixed if you think you're paying too much? Stay floating and instead buy a cap. Now, you typically pay for an interest rate cap with a one-off premium, a fee if you like, up front. It's not refundable. Now, this premium is a function of interest rate volatility, so how much a rate's shooting around and the expected payoff. And what this cap is going to allow you to do is take advantage of rates if they stay below the cap rate. So if rates carry on staying lower for longer, lucky you. But don't worry, every time rates set above that cap rate, the bank will pay you the difference between where rates are and the lower cap strike. So you get the best of both worlds. You know the maximum amount of interest you're going to pay. So if I, the bank, am going to have to pay you when rates go above the cap strike, where you've set your level of protection, I'll take these into account. If you want to lower the premium, sure, reduce my payoff by raising the strike. In other words, you take more pain on the interest side before I start to get involved and have to compensate you. In fact, if you tell me what you're willing to pay, I can simply solve for the new strike. This is no different from medical insurance, for example, or car insurance, where you help the insurance company out by reducing their payoff. Now, as an aside, when somebody calls up a bank for a cap, the strike will usually be set at where the swap rate is at that time, since this is the average of where rates will go, so that we say the strike is at the money. If the strike is set lower than the swap rate, it's in the money, which will be obviously more expensive because I have to pay you out sooner, and out of the money if it's set higher than the swap rate. In other words, rates have to move against you a bit more before I start to get involved.